I have been thinking a lot about the changing global landscape, and I am ready to share my thoughts. I have studied financial systems for nearly 50 years, and time has a way of teaching you which signals matter and which ones are just noise. I lived through the inflation panic of the late 1970s, watched the crash of 1987 unfold in real time, and saw the credit machine crack apart in 2008. I also watched the emergency printing and market rescue of 2020, when trust almost vanished for a few dangerous weeks. When certain patterns begin to repeat across decades, I stop calling them headlines and start calling them warnings. The warning today is this global gold rush, and it will hit the Western economy harder than most people understand. Since 2022, central banks have bought more than 1,000 metric tons of gold a year, about twice the yearly average seen in the years before that, and they kept doing it even as prices climbed. That is not jewelry demand, and it is not fear from small investors. It is the behavior of nations preparing for a world where paper reserve assets may not be enough. After roughly $300 billion of Russian sovereign reserves were frozen, every reserve manager on earth had to ask one cold question: what is still yours when politics turns hostile? Most people heard the story and moved on, but the people who run the money took it as a signal that changes everything. If you want these warnings before they reach the front page, stay close to this chair by the fire and keep this work in your circle. The next shift will not send an invitation, and those who wait for comfort usually arrive after the damage. To understand why this matters, you have to understand what reserves really are. A country's reserves are its emergency savings account, the pile of assets it can reach for when its currency shakes, trade slows, or foreign lenders step back. For years, the West taught the world that the safest reserve asset was a government bond, especially a U.S. Treasury, because it was liquid, accepted everywhere, and easy to store on a screen. But a bond is a promise on paper, while gold is the asset itself. And that difference becomes huge when trust is under pressure. Think of it like the difference between a restaurant receipt and the meal. The receipt proves a transaction happened, but if the kitchen shuts down, the paper does not feed you. Gold works the same way in a reserve system. A ledger entry tells you what you are owed, but a bar in your own vault is what you control. Most people, and sadly many advisors, still speak as if liquidity and ownership are the same thing. They are not. When the rules stay stable, paper looks efficient. When the rules change, paper can become a question mark overnight. What most advisors never explain is that reserve systems run on confidence layered on top of collateral. Collateral is the asset posted behind the promise. Confidence is the belief that the promise will still be honored tomorrow morning. In calm markets, those two things look identical. In stressed markets, they separate fast. That is why a nation can appear wealthy on paper and still scramble for the few assets nobody has to approve. A friend of mine named Daniel is 58, a careful tax partner at a mid-sized law firm, and for years he thought gold talk was for nervous people. He loved numbers, trusted institutions, and kept telling me that civilized markets do not go backward. Then he started reading central bank filings after the Russian reserve freeze, and one chart stopped him cold. He saw that the dollar share of reported foreign exchange reserves had slid for years, while central banks were buying gold at a pace not seen in decades, and at the same time he watched China cut its treasury holdings far below the levels it once carried. Daniel called me late one evening and said, "I think I finally understand it. This is not a bet on disaster. This is a bet on ownership." A month later, he moved 30% of his liquid long-term savings into fully allocated physical gold held outside the banking system, and he told me he slept better the first night after he did it. Daniel was not reacting to price alone. What changed him was the pattern. He saw that central banks were buying at record levels even after gold had already moved higher, which meant they were not chasing a quick trade. They were accepting a higher price in exchange for stronger control. That is what professionals do when the risk is structural. They stop asking what is cheap this month and start asking what will still be safe if the rules drift. When you look at your own savings, are you holding assets or are you holding promises about assets? And if the answer is promises, how sure are you that the promise matters when the room gets tense? Now, let me give you the hard numbers because the math does not lie. First, the buying is relentless. Central banks have added more than 1,000 tons of gold in each year since 2022, after averaging about 457 tons a year from 2016 through 2021. That means the largest reserve managers in the world are no longer treating gold as a dusty leftover from the past. Second, the conviction is broad. In the World Gold Council survey, 95% of central banks said global official gold holdings will rise over the next year, and 43% said their own holdings will rise. That means the institutions closest to the monetary plumbing expect this move to continue, not fade away. Third, the dollar share is slipping. The dollar made up about 71% of global foreign exchange reserves in 2001, but around 54.8% by the first quarter of 2024. And if you count gold at market value, the share drops closer to 48.2%. That means the Western system still dominates, but it no longer enjoys the same unquestioned margin of safety. Fourth, the price has already spoken. Gold set 53 all-time highs during 2025, while total annual demand pushed past 5,000 tons for the first time. That means this is not a quiet side story anymore. Capital is already voting with real money. Fifth, the signal from China is unmistakable. The share of gold in China's reserves rose from about 1.8% in 2015 to roughly 4.9% in 2024, while its U.S. Treasury holdings fell from about $1.3 trillion in the early 2010s to around $780 billion by mid-2024. That means one of the world's largest strategic rivals is changing the mix of what it trusts. So let me ask you something that may sting a little. If the people who manage national reserves are moving toward hard ownership, why are you still acting as if your account statement is the same thing as safety? Now, I know exactly what some of you are thinking right now. You are thinking gold does not pay interest, it just sits there, and the dollar is still the center of the system. There is truth in that. The dollar is still the main reserve currency, and gold does not send you a coupon every 6 months. But that objection misses the real job of a reserve asset. A reserve asset is not supposed to entertain you when times are calm. It is supposed to survive when trust breaks, when counterparty risk rises, and when politics enters the balance sheet. Insurance also sits there until the day you need it, and nobody complains that a fire extinguisher failed to produce income. The skeptic sees yield and stops the argument there. The wiser investor asks a deeper question. What is the value of yield if the asset can be delayed, frozen, diluted, or politically constrained at the exact moment protection is needed? I have seen this before. People mock the quiet asset during the party, then search for it when the doors get crowded. If you want proof that this is more than theory, look at what the National Bank of Poland actually decided to do with real money. In 2024, its board approved a plan to lift gold to 20% of official reserves, a move that implied buying another 226 tons and taking total holdings toward about 585 tons. That is not a speech at a conference. That is a concrete balance sheet decision from a NATO country inside the Western orbit, made after years of inflation shocks, war risk on its doorstep, and rising doubt about what reserve safety now means. And Poland is not the only signal. More central banks are also thinking about storing a larger share of gold at home where legal control is clearer and political distance is shorter. When an institution that size moves metal instead of making speeches, the rest of the market usually wakes up late. Think about how unusual that is. A Western allied central bank is openly choosing more metal over more paper at a time when many households are being told that broad market exposure solves everything. Poland had already bought about 130 tons in 2023, and then it set a fresh target anyway. That tells you this is not a symbolic gesture. It is a strategic repositioning by people with long memories and direct access to state risk. Have you ever asked yourself why governments are trying to own more certainty while households are being trained to own more abstraction? If that gap keeps widening, who do you think will be left exposed when the rule book suddenly matters? Now widen the lens. China has not been buying gold for decoration. China has been building options. It has raised the share of gold in its reserves while cutting back its exposure to U.S. treasuries. And that tells you it wants less dependence on a financial system controlled by strategic rivals. In plain terms, China is reducing the number of doors that Washington can close. Russia provided the harsh tutorial. After the invasion of Ukraine, roughly $280 to $330 billion of Russian sovereign assets were frozen, and a large chunk sat inside European financial plumbing. Even countries that dislike Russia learned the same lesson from that event. Foreign reserves are only untouchable until the wrong geopolitical line is crossed. Once that message spread, gold stopped looking old-fashioned and started looking neutral. Then come the emerging market central banks, many of which have been the most active buyers in this cycle. They face inflation risk, currency pressure, and the need to keep public trust when global capital turns moody. Gold helps them diversify without needing permission from another country's bond market. Now bring in Washington. The United States still has the deepest capital market on earth, but it also has huge deficits, rising interest costs, and a habit of using the dollar system as a tool of statecraft. That power is real, but power used often teaches other nations to search for exits. Add one more layer, the supply chain shocks that followed the pandemic, war, and strategic decoupling. When countries realize that goods, payment rails, energy flows, and reserve assets can all become weapons, they start seeking assets that travel outside someone else's promise. These forces are coming from different directions, yet they are all leaning toward the same conclusion, and that kind of convergence is never an accident. This is why Ray Dalio keeps warning about changes in the monetary order. He knows that reserve systems do not break because one chart looks ugly for a week. They change when debt, geopolitics, and confidence begin to lean against each other at the same time. The public usually notices the last stage. The insiders respond to the first stage. We are much closer to that first stage than most people want to admit. Do you actually know what happens to your investment if the rules change overnight, the broker changes terms, or the market opens with new restrictions? Have you read the fine print closely enough to know whether you own the asset itself or only a claim that works until somebody higher up says otherwise? Let me take you back to a scene from before most living investors were born. In the early 1930s, during the bank failures that helped bring on the American bank holiday of 1933, ordinary people stood in long lines outside locked doors holding passbooks, statements, and certificates that looked solid only days earlier. Those papers were claims on money, but a claim is not the same as cash in your hand when the bank cannot open. The man who had a neat folder full of bank promises found himself staring at a shut window. The woman who had kept some cash at home or held gold coins and small hard assets had choices while others only had questions. Later came the restrictions, the emergency orders, and the new rules about what citizens could hold and how gold would be valued. The point is not that history repeats line for line. The point is that systems under stress reveal the difference between a paper right and a directly controlled asset. We saw a related lesson again and again through the 20th century, from currency devaluations to capital controls to sudden bank closures in weaker economies. People with paper claims often had to wait, negotiate, or accept changed terms. People with the real asset or real equity in productive businesses at least had something that did not depend on a clerk reopening the drawer. That old pattern is not dead. It is forming again right in front of us, only this time the suit is digital and the language is more polished. Picture the scene clearly. Men in hats, women holding envelopes, clerks behind dark glass, and a rumor moving faster than any official notice. That is what a trust problem looks like in real life. It is not abstract. It is a line, a locked door, and a promise that suddenly needs permission. The tools change with time, but the human feeling does not. When access disappears, people learn what they actually owned. The first possibility is the gentle version. Central bank buying stays strong, the West adjusts slowly, bond markets digest the shift, and the economy absorbs higher stress without a dramatic break. In that world, fully allocated physical gold still does its job because it remains a trusted hedge, while paper assets work harder to earn the same confidence. You do not need chaos for direct ownership to make sense. Stocks may still rise in bursts, and commentators may call the fear excessive, but underneath that calm surface, the reserve mix would keep tilting toward hard collateral. The second possibility is the middle road. Foreign demand for Western debt weakens enough to push yields higher, fiscal pressure grows, currencies wobble, and households start to feel the squeeze through borrowing costs, taxes, and slower growth. In that world, fully allocated physical gold performs well because it benefits from distrust, diversification demand, and the rising price of monetary insurance. The adjustment hurts, but the protection still works. Paper wealth would look fine one quarter and feel thinner the next, which is exactly when ownership begins to separate from valuation. If either of those outcomes arrived over the next year, would your savings be arranged for calm headlines only or for changing rules as well? That is not a dramatic question. It is the adult question. The third possibility is the hard landing. A geopolitical shock, a debt scare, or a market freeze causes a fast scramble for collateral, confidence, and political control, and governments respond with measures few people expect in advance. In that world, fully allocated physical gold again stands out because ownership, not yield, becomes the center of the story. Mild, moderate, or severe, the same position keeps showing up on the winning side of the risk map. In that kind of week, the account statement stops being comfort and starts being a test. So what do you do this week? First, understand what you currently own. Read the statements, the custody terms, and the fund documents, and find out whether you own direct assets, pooled claims, mining shares, ETFs, futures exposure, or something even more layered. Second, move toward the safest form of the relevant asset, which in this case means fully allocated physical gold with clear legal title and storage you can verify, not a vague promise wrapped in clever language. Third, watch one signal with discipline: the pace of central bank gold buying and the direction of the 10-year U.S. Treasury yield together, because when official demand for gold stays high while Western borrowing costs climb, the message is hard to ignore. Fourth, act before stress becomes visible to everyone else, because once a reserve shift becomes a public panic, spreads widen, premiums rise, liquidity thins, and your options usually get worse instead of better. Fifth, prepare yourself emotionally and financially for volatility ahead by keeping cash for living needs, reducing leverage, and deciding now how much price noise you can tolerate without making frightened decisions later. Do not overcomplicate this. You are not trying to outguess every central bank meeting or every headline from Washington and Beijing. You are trying to reduce the number of weak links between your savings and your future choices. The point of a plan is not excitement. The point of a plan is to make sure a noisy month does not force a foolish year. Quiet preparation still beats urgent reaction. Ask yourself one clean question before this week ends. If ownership starts to matter more than convenience, have you already done the hard work, or are you still trusting speed, branding, and habit to protect you? Gold is not moving alone. Central banks are moving first. Reserve managers are changing behavior. Governments are studying seizure risk. China is reducing dependence where it can. Russia taught the world an ugly lesson. Emerging markets are listening with both ears. Western debt is growing heavier each year. Interest costs are becoming harder to hide. Supply chains have turned political. Paper safety is losing some of its shine. Direct ownership is gaining respect again. The old reserve order is bending, not breaking. But bends become breaks when pressure keeps building. Quiet balance sheet changes become loud market moves later. Gold is telling you trust now carries a premium. Bonds are telling you funding will not stay effortless forever. The dollar still stands tall, but it is no longer standing alone. The strongest system can still be strained by math. The richest economy can still pay more for capital. The clean statement can still hide messy exposure. The polished app can still rest on old chains. The small print still matters when stress arrives. The calm years teach bad habits. The hard years expose them. Ownership matters more when politics gets involved. Liquidity matters less when access gets rationed. Convenience matters less when terms get rewritten. This is how transitions begin, not with trumpets, but with reallocations, not with slogans, but with reserve reports, not with panic, but with preparation. Households tend to laugh last at the wrong moment. Officials tend to move first and explain later. That is why this subject feels quiet now. Quiet is how a structural shift sounds before it becomes expensive. So ask yourself something uncomfortable. Are you preparing for a world that looks like the last decade, or for the world that reserve managers are quietly preparing to enter? There is a real difference between those two choices. Most people will notice only after prices move. Most institutions are already adjusting now. You do not need to predict the exact day. You only need to respect the direction. If the people closest to the system are moving toward harder assets, pretending not to see it will not protect you. It will only delay your response. Delayed responses are how ordinary savers end up financing other people's lessons. The cruel part is that the warning signs are public. The sad part is that the public keeps treating them like background music. Central bank purchases are public. Reserve composition trends are public. Treasury auction stress is public. Fiscal arithmetic is public. The freeze on sovereign assets was public. None of this is hidden. It is merely ignored because ignoring it feels easier than changing course. I am not asking you to be afraid. I am asking you to be honest. Be honest about what you own. Be honest about why you own it. Be honest about how it behaves when trust gets repriced. In my experience, the people who come through these shifts with dignity are rarely the fastest traders or the loudest voices. They are the men and women who understood the structure early, simplified their exposure, and refused to confuse convenience with control. They accepted that safety sometimes looks boring before it looks wise. They understood that a smaller return on paper can still be a bigger victory in real life if it keeps options open when others are trapped. Survival first, flexibility second, opportunity comes after both. And one more question deserves an answer tonight. If your broker froze trading tomorrow, changed collateral terms next month, or sent a careful legal notice next quarter, would you feel surprised or would you feel prepared? The difference starts with what you do before bedrock starts shifting. Think about the Western economy from that angle. If foreign central banks buy less Western debt and more gold, someone else must absorb that debt. That usually means higher yields, heavier refinancing costs, more pressure on public budgets, and tighter financial conditions for businesses and households. Mortgages feel it. Small business loans feel it. Commercial real estate feels it. Banks feel it. Governments feel it. Pension funds feel it. None of this requires a dramatic collapse. A slow repricing is enough. A steady rise in funding costs can do more damage than one bad headline. It can choke investment. It can pressure asset values. It can force harder political choices. This is why the gold rush matters in the West, even if you never buy a coin. The movement of reserves changes the price of trust, and the price of trust touches everything. That is the deeper warning behind Dalio's concern. When monetary orders change, the first sign is usually not a flag coming down. The first sign is that the plumbing starts favoring a different mix of collateral. Gold does not need to replace the dollar tomorrow to hurt the Western economy today. It only needs to compete harder for the role of trusted reserve asset. Every percentage point of doubt has a cost. Every shift in official demand has a price. Every new reason to hold metal instead of paper tightens the terms for everyone who depends on cheap borrowing. That includes governments, corporations, homeowners, and retirees. One side is seeking more independence. The other side is assuming the old dependence will last. That mismatch is where strain builds. That mismatch is where complacency gets punished. That mismatch is why I am speaking to you now. Markets can absorb one shock and hide the damage. They struggle when shocks begin to stack. A trade dispute raises costs. A sanction rewrites assumptions. A deficit widens quietly. An auction clears at a higher yield. A central bank buys more gold. None of those moves seems fatal by itself. Together, they tighten the same financial rope. That rope runs through rates, credit, housing, hiring, and confidence. By the time television panels call it obvious, portfolios have already been repriced. That is why patience matters now. Patience is not delay. Patience is calm action before the crowd feels urgency. You still have time to simplify. You still have time to read the fine print. You still have time to choose ownership before ownership becomes expensive. And once urgency arrives, good options rarely get cheaper or clearer later. So remember the chain. Gold buying is rising, dollar share is slipping, sanction risk changed reserve behavior, China is hedging, emerging markets are diversifying, Western debt still needs buyers, higher funding costs ripple outward, ownership beats assumption when pressure builds. Paper claims can be useful, they just are not control. If you forget everything else, remember this. The safest looking system often becomes most dangerous the moment people stop questioning it. The people who survive financial turning points are not the ones who knew every forecast. They are the ones who knew what they owned. When the age of easy promises ends, the real asset gets the last word. Who in your life needs to hear this before the next policy shock, the next market freeze, or the next quiet rule change catches them leaning the wrong way? If someone you care about still thinks a statement is the same thing as ownership, send this to them while there is still time to prepare. And if you want the full breakdown of exactly how to position for what is coming, everything you need is in the link below.